All right. Good afternoon and welcome to the Eastside Real Estate Team's podcast. I am Dan Edwards with the Eastside Real Estate Team, and I will be podcasting with you today. We're back from a bit of a hiatus. It is Wednesday, November 16th. And if you are watching this live, please press the like button, subscribe on our YouTube channel, whichever way you're doing it. If you're listening to this later, we hope you find this content interesting and engaging. Please do subscribe to a Google Podcast or YouTube or what's it called? Google Podcasts or anywhere else that podcasts are cast. I think we're on everything. So love to have you subscribe. Today, we're going to be welcoming Daniel Curry of Guild Mortgage and Dan Gelhay of Eastside Insurance. So we're going to have a Dan-a-thon today. It's going to be a lot of fun here on the podcast. But before we get to our guests, let's start with some real talk and address the big question. Why is today's housing market not like 2008? What's the big difference? Now, you can find a post about this on our blog at the eastsiderealestateteam.com. But we're going to just talk about all the headlines going out there and what everybody is saying in the world of real estate in the industry is that they're very concerned that this market is going to look a lot like 2008, where we had a record number of foreclosures. And eventually that turned into people looking for solutions on what we called short sales. Now, the good news is there's concrete data to reflect that there's nothing like that going to be happening. And the big issue is still supply and demand. Now, I know there's still a lot of things that are going to be shaking out in the economy over the next 6 months. So we expect a lot less consumer confidence that we saw, of course, over the last few years. But in 2008, there was more going on at the foundations of the financial markets that created a cascading effect that started in the housing markets, but didn't end there. It basically went global. So one of the interesting things to do is that when we look at the numbers, we look at a key index called absorption ratio. And absorption ratio is another way to say how many homes do you have in the market that when a home is sold, and if enough homes are sold in a specific time period, you would run out of available inventory. Now, in the height of this recent boom, we were as low as 1 week's worth of inventory. That meant a home came on the market and left the market. A home came on the market and left the market in a 7-day span. Well, that absorption ratio, as you could guess, because inventory being so low, creates highly competitive market, and it drives buyers to bid above asking price, waive inspection, to waive all contingencies, including financing contingencies, and also find alternatives to help them come up with cash offers. So we saw a lot of that going on. And what we found out is when the market changed, that changed too. And it was rather brisk. And that happened basically in May of this year. Now, what most people felt like was that the market was crashing. But the truth is that we were basically starting to normalize. Many would-be buyers decided to back away, and many would-be sellers did the same thing. So what we didn't see is people dumping inventory because they had to, like they did in 2008. What we really did see is we saw people that really had to sell list their home. Those that maybe could held off. Some of them may still sell, and it may be next year, and probably should have sold sooner in order to avoid what will look like a significantly lower price than they could have got this year. It might be next year, it might be even less. So essentially, around the entire nation, we have approximately 3.2 months of supply, 3.2 months of inventory. And the truth is a balanced market is 5 to 6. That's a balanced market. And that's where you get statistics like buyers are looking at 12 homes, kicking the tires, and then offering one. In this market, on the east side, we're actually still at just 2 months of inventory. Actually, 1.94 is what it is. So we still have a supply issue. And I have to tell you that builders are also pulling back their pace. And there's a couple of reasons for that. Supply issues is one, labor issues is another. And then they're seeing in the market that if they slow their build rate, they can actually keep their prices relatively higher. So they're not building. And many of the municipalities, cities and counties have a logjam of permits and essentially aren't really casting a lot of new permits in the area for new properties. So that actually keeps, especially with the influx, keeps prices high. All right. So let's see, what else have we got here? So one interesting thing too that we're seeing in this market that we didn't see in that market is that there is a fair amount of equity that has built up since 2012, which is when the market really turned around. So 2008 to 2012 was the down years. 2012 to 2022 were the up years. So there's quite a bit of equity, and that's why we're not going to see that kind of crazy short sale foreclosure situation, because yes, there are some sellers that when they sold, if they had sold in, say, January, February of this year, might have earned $800,000, but now they're selling for $700,000. They still bought when it was $400,000. So there's still some equity. That means you're not going to run into the distress sales that we had. And so if a seller is not in distress, they may choose not to take that loss, but to stay in the house another 3 to 5 years. So in conclusion, there's a lot going on. And certainly the market doesn't feel like the fast-paced market of last year. Interest rates are causing an impact that creates an affordability factor for many, but creative agents are helping buyers work with their lenders to get a favorable rate by using what we call a rate buy down. And that's where the seller, instead of taking a lower price, offers credits to help reduce the actual cost of money to the buyer. Because to be honest, the buyer, they're buying the mortgage payment. Yes, they're buying the house, but they're paying the mortgage payment. And if the mortgage payment fits in their price point and they plan on being there 3 to 5 years, then having the seller finance essentially by crediting a lower rate makes a lot of sense. So if you're out there and you're thinking about buying, if you need to sell, we would love to talk to you at the Eastside Real Estate Team, and we hope that you reach out. You can find us online at the Eastside Real Estate Team, or give us a call at 425-200-4093. I'm Dan Edwards, managing broker with the Eastside Real Estate Team. Now, after our short break, we're going to welcome in Daniel Curry from, wait, maybe that's not what it says. Okay, well, we'll be back after this short break, and we're going to welcome Daniel, our lender. Come on back after this break.
Are you tired of not knowing where your money is going? Do you feel like you start getting ahead on your finances, then get hit by an unexpected expense and feel behind? Doug Peterson with Get Priorities Straight helps guide you to getting your money to do what you want it to do instead of wondering where it went. Doug has helped ambitious, busy, successful people be delighted by handling their money wisely. To have a conversation with Doug, call 206-264-4424 or email meeting@letsgps.com or info@getprioritiesstraight.com.
Welcome back to the show. I'm Dan Edwards with the Eastside Real Estate Team, and you're listening to Seattle's Eastside Real Estate Team podcast. All right, we are here with Daniel Curry, and Daniel Curry. Oh, I should actually bring him back on the show. Boop, there he is.
Hey, how you doing?
How are you?
I'm good. Thanks for having me.
Thanks for coming on. So we're going to talk about why now is still a great time to buy. I alluded to it in my Real Talk segment, and I thought we'll have a good conversation about that. Talk to me a little bit before we get into this, because I like to ask this question, because this is a show about the ins and outs of real estate. I want to step into the world where real estate is your home, right? Not just a physical asset or an investment. Tell me about the first home or the home you grew up in.
So the home I grew up in was about a 2,000 square foot house in Mukilteo, right on the border of Mukilteo and Linwood. When I was growing up, there was 30 acres that surrounded the property. And it was great to have, dirt bikes and all the fun stuff of it playing out in the woods as a young kid. But recently, in the last probably 5 or 6 years, they knocked down that acreage and put up, I think, 45 homes. Wow. In this small area. So Driving back through my old neighborhood, nothing looks the same anymore. I mean, my house is still standing, but the house is even a different color now. So
It's like progress, right? It's kind of disappointing.
it is.
So Mukilteo, what did you guys go play in the fields in the summertime? What did you guys do?
Oh yeah, like I said, a lot of dirt bike through the trails in the pasture that was there. It was actually the backside of an old pony farm that had been decommissioned, so there was plenty of trails to go run around in, build forts, playing cops and robbers and throwing sticks at each other, and boys will be
Throwing
boys.
sticks at each other. I hear a catch. All right, cool. So that's the point of home ownership, right? It's about having a place where you can call your own, relax, enjoy your time away from your work life, maybe raise a family, all of those things. And then secondarily, it's your biggest investment. So I just think I'd like to talk a little bit more of the personal side. So why is now the best time to buy a house, Daniel?
So right now, what we're seeing is kind of an interesting dynamic that's breaking out. You have interest rates that have started to fall. Here was it a week ago? We had interest rates drop by almost a full percentage point in a day, which was just something that nobody really saw coming. But you have that end of things, and then you also have homes sitting on the market a little bit longer than they were, say, 6 months or a year ago, where people are starting to offer the seller concessions. There's better prices. There's more negotiating room, things of that nature. And right now, you have kind of the perfect storm of the best time to buy. Granted, interest rates are somewhat elevated compared to the last year or two that we got used to seeing through COVID. But if you look back over the last 10, 15, 20 years, interest rates are significantly lower than they were even 5, 10 years ago.
Mm.
The big thing to remember is that there's so much equity that's in the market right now and that can be continued to be built, with home appreciation throughout the next 3 to 5 years, that the one thing I can fix is interest rate. When interest rates come back down, we can go in and refinance the house, restructure from a 30 to a 15-year loan, things of that nature to help save you some money. But what I can't fix is the equity that's lost in waiting. So take advantage of the lower price points now, the seller concessions, and then we can worry about the interest rates at a later date.
Yeah, Daniel, I think that's something that's missed oftentimes when we talk about crashes, ups and downs, is equity lost, right?
Mm-hmm.
Those
Absolutely.
individuals that are renting, they can't get that rental money back in any way,
Exactly.
shape, or form. When you pay a mortgage, you're paying interest. There's a credit on your tax return, and you're paying a slight bit of principal at the beginning. But it is like a forced savings plan, and you can't go back in time and retroactively take that rent that you were paying somebody else and get anything for it.
Unfortunately,
So a bubble, not a bubble, crash, not a crash. Why is there no bubble from your perspective?
like you kind of touched on this earlier in the show, and that was supply and demand. I mean, when you go back to when the bubble happened back in 06, and even the years preceding that, you look at the amount of supply, the amount of demand, and then you take it a step further and actually understand that what caused that was the illicit lending practices that have now been made illegal, if you will. There was a lot of loans back then that were done with no income verification. Debt to income ratio wasn't really even a thing. The qualifications back then was basically if you had a pulse and could make a signature. It was really a dangerous way to do lending at that time. And since then, we've restructured the lending side of things to bring in debt to income ratios, verified assets, verified 2-year history of working. And things have kind of tightened up to where the loans that are being drawn up now are so much more secure than they once were. So that side of things has kind of been removed from it. But then you still have the supply and demand issue, like you were saying. You only have a couple months of supply that's currently still available in the market. And without going on a big long tangent, if you go back 35 years ago, you're going to see a population boom that really rivals the baby boomer generation. And what we found is in the last couple of years is the average age of somebody to purchase their first home is roughly 33 years of age. So as far as demand goes, we're going to continue to see demand really, really weigh down on the supply chain, on the supply of homes.
Okay. So I agree. The bottom line is people want a place. I mean, we learned that in the pandemic.
Absolutely.
So what kind of prediction are you seeing for the next, well, let's just give me the next 6 months.
The next 6 months, I think that, and it's kind of an unpopular opinion, but I really think what we're going to see is the data that the Feds have been raising interest rates according to try to get inflation under control. I think we're going to see that data show that they've already reached where they need to be at, or are right on the tipping point of getting inflation to start coming down. And when we see that, when inflation comes down, interest rates come down. So what I'm thinking is over the next 6 months, we're going to see interest rates come down. Some people are calling for interest rates as low as 4.5%, 5%. I think it's going to take us a little bit longer than the next 6 months to get to that area, but we should definitely see some relief in the next 6 months. And when that happens, everybody that's spent the last year or 6 months at least on the sidelines waiting for homes or waiting for interest rates to drop are going to jump back in the market. When that happens, I worry that we're going to see another feeding frenzy, kind of like we did over the last year, where you're going to have, people bidding over asking price, waiving every contingency there is out there, and offers, in the teens or the 20s on a single home.
So Daniel, you think that will happen if we drop down to 5% again?
I think it will.
Wow.
I think that there's enough people that realize that 2% and 3% interest rates, while they were great to have during the pandemic, we're not going to see those interest rates again. The Fed's not going to reduce the Fed interest rate to zero again. There's just no reason for it.
And so where are rates today?
Rates today are roughly about 6.25 or so.
Okay, 6.25.
Depending on product. I mean, there's some variation there, but
yeah, I think the interesting thing that we're seeing too is our inventory is doing a seasonal adjustment, right? So we're actually coming down on inventory, or it's still not the same as our inventory last year at this time. Thank goodness, because quite frankly, we need to have a fair amount of inventory so people can do that. So
absolutely.
I do not see us doing that ever again in the next 10 to 15 years, because that just was ridiculous. I can tell you on the East Side in December of last year, 92 homes homes across the East Side available for sale. That is not a sustainable number to ever get to.
Definitely not.
So yeah, I think we're just going to kind of bounce around. And quite frankly, yes, I would say if somebody saw, so here could be this, I'm just kind of spitballing here, but here could be a really good scenario for a prepared buyer. Is you're fully underwritten, ready to go, and you're hanging out, you're talking to Daniel, you're making sure all your stuff is current. And our market next year, you get out there, you're looking at stuff, suddenly interest rates drop below 6, and you have a house that's maybe been on the market for a while, and now you can actually get a credit and get a rate buy down to below 5%.
Right.
Right.
We are currently offering the 3-2-1 buy down. So instead of doing just 2 years of that lower interest rate or 2% lower on the interest rate, we actually have an option to go to a third if the math makes sense.
Yeah, so, if the credit is enough. And you happen to know, is that about 4 points for something like that?
It's right around 3.5, 4 points, depending on the size of the loan.
Okay. Yeah. So again, this would be a scenario where we haven't seen this before, but the seller is actually, instead of reducing the price, is actually crediting 4 percentage points of your loan so that you can get a better cost for your money. And Daniel knows this, and I just want our listeners to know this, that essentially you have to qualify for the one interest rate. So if current rates are 6.125, you qualify at 6.125, but you're paying, what is it? That would be 3.125
in that
for the
case.
First year, et cetera, et cetera. So,
and the cool thing with that program is that money goes into an escrow account. So what happens is the balance that's in there after each payment comes out, it doesn't just go away like a permanent buy down. It goes in an escrow account, and if, say, in a year from now interest rates fall to 4.5% and you want to lock in that 4.5% interest rate, we can refinance you, and whatever's left over in that account goes towards a principal reduction.
Oh, nice.
So it's really a sweet program for
I didn't even
everybody.
think about that.
More money in everybody's pocket.
I didn't really think about that. That's awesome. All right. Well, hey, I don't want to. We've got a lot of other questions, but I don't think we have time for all of them. Why don't we talk about why to work with you and a local lender, Daniel?
So local lenders bring a whole nother aspect and dynamic to the lending experience. And the first thing I point out with people is a lot of your local lenders we're direct lenders with Freddie and Fannie and everybody else. So there's no, we're all kind of dealing with similar rates, as opposed to some of these call centers that are in the Midwest that are the .coms, if you will. And what you have with that is you have somebody that is paid typically hourly as opposed to commissioned. And whether your loan closes with them or not, they get paid. For us, just like with your realtor, if that deal doesn't go through, your loan doesn't get paid, you're not satisfied, and ultimately we don't end up getting paid. So the amount of care that a local lender puts on your loan and on your buying experience is incredibly better than you would have with some of these .coms that may offer a little bit cheaper interest rates.
Yeah.
Additionally,
shout out. I'm sorry to interrupt. Go ahead.
That's okay. Additionally, we are familiar with the area. We're familiar with the local landscape of what people are doing in this market and able to set you up with realtors in your market.
Yeah. And I have to say that there are tons of internet, farms that do financing, some, mortgages, some do a good job. But I would say that the most important thing is that you have somebody you can call any time of the day. And not only that your real estate agent can get a hold of.
Absolutely.
The places like rhymes with Rocket Mortgage, you never know when you can reach the folks. So,
right.
I just highly encourage you to consider. So, Daniel, how do people get a hold of you?
You can either give me a call at 425-239-0788 or send me an email at daniel.curry@guildmortgage.net. Available anytime for you.
All right. Yeah, I appreciate you taking the time to come on. Thank you so much. We hope to have you back.
Definitely. I'd love to. I appreciate you having me on there, and look forward to listening to the end of the podcast.
All right. Very good.
Thank you.
After this short break, we're going to welcome in Dan Gelhay from Eastside Insurance Services. Come join. Don't go away. We'll be right back.
Tired of the same old conversations at networking events that never lead to new clients? BNI is changing the way the world does business by connecting you to strategic relationships that can help you grow your business. BNI is the world's largest networking organization, helping hundreds of thousands of members around the world each year increase revenue through relationship marketing. For information about visiting a BNI chapter near you, go to the BNI Northwest website at bninw.com.
Welcome back to the show. I'm Dan Edwards, and you are listening or watching the Seattle Eastside Real Estate Podcast. We're here. Joining us here in a moment will be Dan Gelhay. He has lived and worked in the Puget Sound community for over 20 years. I've known Dan for over 10. He resides in Eastern King County with his spouse and 2 children. Dan is in his 12th year. So I've known you over 12 years. Working as an independent insurance agent. He brings 25 years of experience in finance and risk management knowledge and expertise to his clients. Dan is straightforward and he's super friendly, pretty laid back. He likes taking photos. He does a really great job with photography. So please join me in welcoming Dan to the podcast. Hey, Dan.
Hey, Dan. How are you?
It would make sense to have one of your pieces of art behind you there.
We just moved into a new space not too long ago, and so I'm working on that actually.
Gotcha. It looks very insurance-esque.
Yeah, it does.
All right, cool. Well, I have to say this is a great time of year to sit down and evaluate home insurance and everything as a whole. And this is an endorsement for Dan because I've been working with Dan for a long time. There are insurance agents who just do the thing. They get the insurance, they do it. They're order takers. And then there are those that are consultative in your approach. And Dan rises to the top, and he's always looking out for your best interests. I get regular calls from him about our policy, and that's not a normal thing. And I always got to say that I appreciate you, and so do everybody that I've ever sent you to. Always appreciate you. So, all right. So tell me about Eastside Insurance Services, Dan.
Yeah, well, first off, I appreciate the kind words, Dan. So, Eastside Insurance, we are a longstanding independent personal lines agency. And basically, what independent means, it means that we work for our clients, not any one insurance company. So, we have a pretty rich menu of companies that we partner with. So, it gives us a lot of flexibility to go out, shop the market, put nice tailor made packages together for our clients. And we service all of Washington State. And when I say personalized insurance, what I mean by that is we do auto, home, rental properties, renter's insurance, earthquake, flood, and then all the toys. So boats, motorcycles, RVs, classic cars. We really specialize and hone in on those personal lines.
Awesome. And then the personal lines. Now, as we kind of get into today's topic, the end of the year checkup. So what are the major homeowners insurance covers? What are the major issues?
Yeah, there's really four major parts to homeowners insurance that I'll talk about. There's a lot of endorsements that can be added on, but kind of the major coverages that most people grasp onto are the dwelling coverages, right? So first and foremost, the physical structure on the property, your house, and then any other structures that may be on the property, like a gazebo or a detached garage or something. You've got personal property coverage for anything that you take with you when you move. So, your clothing, your electronics, your furniture, things of that nature. A little known component of homeowners insurance is something called additional living expense. So think of this, Dan. Let's say you have a major fire at your house and you have to go live in a hotel for 6 months while the home is being renovated. You still have to pay your mortgage, right?
Mm-hmm.
But now you have this additional living expense because you've been displaced. So homeowners insurance will help cover that inflated living expense for the period of time that you're displaced. And then personal liability. So anything that's not auto accident related that you may be held liable for, homeowners insurance can be a stopgap for that too.
All right. Are there things that homeowners insurance won't cover, will not cover?
There are. So what I want the listeners to think about are maintenance repairs. So anything that is just normal wear and tear that you have to take care of as a homeowner typically is not covered by insurance. So think of things like, just the roof is worn out, the paint,
Gutters falling off.
gutters falling off, leaky windows after a long period of time, stuff like that. And then your standard homeowner policy also does not cover damage from flood or earthquake. And a lot of people don't realize that. There is specialty companies that will add that coverage on if it's important to a homeowner, but it's typically not covered on a standard policy.
Now, is that just in Washington State, the earthquake? Because I'm guessing California is probably automatically on there, right?
Actually, it's not.
Wow.
It works the same way. Yep, nationwide. Yep.
Nationwide, separate group of money that you got to pay. Okay, I gotcha.
Separate.
What are the most
Separate.
common types of homeowners insurance claims?
I would probably categorize it into two different types of claims. So there's property claims and liability claims. So for property claims, and this is kind of nationwide averages, but the most common type of property homeowner claim is wind and hail damage. It comprises of about 45% of all property claims on homeowner policy. The average payout is somewhere around $11,000 to $12,000. Fire and lightning damage would be the second most common type of property claim. The average payout is way higher. It's about $78,000.
Now you lump fire and lightning together?
Yeah, because oftentimes lightning will
Leads to fire.
lead to fire. So, and then non-weather water damage. So things like freezing pipes or a burst pipe. That's just under 20% of all property claims with an average payout of about $11,000. And then liability claims. And what leads liability claims for homeowners insurance actually is dog bites. It's about a third of all liability claims, with the average payout being just under 30,000.
So dog bites fall under homeowners, huh?
Falls under homeowners, yep. And then home accidents. So if someone slips and falls, or something falls over and
Trips
hurts
on a
someone.
hose, crack in the walkway.
Yep.
Mhm.
Exactly.
So all those fun fail armies that you see in the Ring doorbells, those individuals could probably call that homeowner and say, "Hey," right?
That's right.
My one claim in that regard, and this is a true story, it'll be funny for those of you listening, is I was showing a house. It was kind of a foggy day like we have in the Northwest, right? Kind of foggy, icy day. And it was what we call a reverse floor plan. Well, what is it? It was the upstairs was the entry, right? So you had to go up a flight of about 25 steps to get to the top stairs. So I showed the house, and we were leaving to walk down the stairs, and it was kind of a, it's wood stairs, so that, they're slippery, right? And I was with a gal who had a cane, and I said to her, I said, "Be careful." And I took a first step, and I went down 25 on my back. It hurt really bad.
Ouch.
Luckily, I didn't break anything, but I did call I called the agent, and they gave me the name of the insurance company, and I filed a claim, and I was able to get chiropractic care with our friend Bob. So that was really super important. But that's my one experience personally with that. It went fairly fine. So
Okay. Yeah, that's a great
let me
example.
ask you this other question is, my daughter is at university, right? And she asked me the other day, she said, "Hey, Dad, if we have fire or water damage, is my stuff covered out here?" And she's renting.
Mhm.
So what do I tell her, Dan?
Tell her that that's a great question, and I'm proud of her for asking that question. And the short answer is yes. So when you have homeowners insurance, you have worldwide coverage typically on your personal property. However, in your daughter's case, it might be a good idea for her to take out a renter's policy for a couple of different reasons. One, it's usually less than a couple $100 a year. You keep the claim off of your homeowner policy. It's a smaller deductible, because typically with your homeowner policy, you'll carry a little bit of a higher deductible, like $1,000, $1,500, $2,000. And so with the renter's policy, you keep your homeowner policy clean of those types of smaller claims, smaller deductible, and she can make sure that her stuff is covered where she's at.
I'll be paying for that. She's not going to be taking it out. She's still under my care at this point. But families that have kids at college, do they have to get one for each?
They should.
They should. Okay.
They should, if they're not living together in a dorm, yes.
Okay. All right. Okay. So let's move on to another question here is, how does inflation affect homeowners insurance right now?
That's a great question. Inflation's kind of a buzzword. It's been a buzzword for several months out there in the marketplace. And inflation absolutely affects homeowners insurance in a couple of different ways. One of those ways is in reconstruction cost. So homes are just way more expensive to rebuild today than they were a year ago, 2-3 years ago. As you know, the cost of building material and labor has skyrocketed. They've come down slightly from their peak, but it's still much more expensive to rebuild a home. And also the cost to repair increases for the carriers. So they're paying out more in average in claims than what they had in the past. So there's a couple of things that it affects. So number one, what we find is that homes are typically underinsured more than what the historical norm is. And that's critical and important for people to understand, because, let's say your home is insured for $500,000, but because inflation has risen so much, it may take $600,000 or $650,000 to actually rebuild your home in today's dollars. There's a gap there, and that can cause issues. The other thing that we're seeing is the premiums that are being charged for homeowners rates to go up a little bit more than what they normally do as well. So on the average year, you'll typically see your homeowner's premium increase about 3 to 5%. We're seeing on average 8 to 15% or even higher now because they're having to raise the coverages on people's homes more than what the norm has been over a long period of time.
Okay. All right. And so the biggest coverage issues you're seeing on a family's homeowner's policy, what are you finding?
Yeah, probably the number one thing is that the home is underinsured. And I mentioned this, roughly 2/3 of all homes across the United States are underinsured, anywhere
2/3.
between 20 to 60%. So it's pretty major. So this means, the risk of major financial loss is there if they have a catastrophic type of a loss. Also sewer issues. So, it may feel that on the surface, if you were to experience an issue with your sewer line backing up or a sump pump failure, that you'd be covered by your homeowner policy, but this requires a separate coverage. It's pretty cost effective to add, but typically it's not covered unless it's added. The other thing I would say is inadequate liability limits. So generally speaking, on a homeowner policy, the maximum amount of liability insurance that one can get is $500,000. But as you know, Dan, especially here in East King County, the values of homes are much higher than that. So what do people do? That's where excess liability or umbrella insurance comes in to give the homeowners added protection to protect their home equity, protect their future earnings, protect any other assets that they may have. So those are a couple of the major issues I see when I'm reviewing someone's homeowner policy. Another one that people don't think about is if they have scheduled jewelry on their homeowner's insurance. Maybe they scheduled it out 8, 9, 10 years ago and their appraisal's 8 or 9 or 10 years old. Well, that piece of jewelry, because the cost of gold and silver and all of that increases over time, you may be underinsured on your property that you have scheduled out.
So what that means when you say underinsured, it means the insurance company will come up and say, you lost this stuff. You're like, yep. And they're like, okay, here, the value is this. And you're like, no, it was 8 ounces. It was 4 ounces, whatever it was. And they come back. They're only going to pay you out what it was, what their max insure payout was.
So I'll give you an example. So let's say that you have your wife's wedding ring scheduled out on your homeowner policy, for example. And let's say you did that 10 years ago and the value at that time was $7,500. Well, the ring today, if you appraised it, maybe it's worth $12,000, right? But you still have it insured for $7,500. Let's say that she loses the ring and you file an insurance claim against that. The maximum amount that they're going to pay out, unfortunately, is what it's insured for at $7,500, even though you can't replace it for that because the cost of the precious metals have gone up.
Gotcha. Okay.
That makes sense?
Yeah, that's a lot clearer because you actually designate a value.
Exactly.
Okay. All right. So finally, what do you recommend our listeners do if they're concerned about their home insurance coverage, cost, or both, and want that end of year checkup?
Yeah, like you had alluded to, now's a great time of year when we're getting ready to turn the calendar over to 2023 to have a checkup done on your homeowner's insurance. So what I will say is that homeowners, generally speaking, can expect an increase of probably 8 to 15% over their last policy term. This is in line with expectations and what we've been seeing. However, that being said, there's still a lot of variation out there, company to company, on what they charge for homeowners insurance. So I would say reach out to their agent, ask for a review of their home policy, ask to have a reevaluation done to make sure they have adequate coverage on their home. And don't be afraid to ask questions. That's what the agent is there for. So if there's something you don't understand on your policy, don't be afraid to ask. And I'm also more than happy to be a resource and offer a complimentary review for any of your listeners.
Awesome. Well, thank you very much, Dan. I so appreciate you. I appreciate you coming on. If you want to reach Dan, you can call him at 425-336-6000. What's your email address?
It is Dan at eastsideinsure.com.
Insure.
INSURE.com.
Insure.com. Eastsideinsure.com. You can just send him your home insurance policy, and he will review it for you. It's worth it. Doesn't cost you anything, and it definitely can save you some money and also protect you a little better. Thank you so much for coming on, Dan. Appreciate it.
Thanks for having me.
All right. Let's just bring our panelists back up on here. Daniel, I got you here as well. So thanks again for coming on. It was a real pleasure to speak with you guys, to hear from you. If you guys know of anybody else out there that is looking to get the exposure like these guys, please connect them with me. We love to have great guests that do great business across the East Side. So thank you so much for coming on. Happy Thanksgiving, and we'll see you next time.
Thank you.
Thank you.